Welcome to the ETF Education series brought to you by ASX, Betashares and Commsec. I am Jacinta King, Business Development Manager Investment Products at ASX, and I'm joined in studio by Ben Smith, ETF expert from Betashares, and Laura Besarati, Market Analyst from Commsec. So welcome, guys.
Hi, Jacinta.
Jacinta.
This is the fourth and final episode of our series on exchange traded funds, or ETFs as sometimes people refer to them. So Laura, let's kick off with how is buying and selling an ETF similar to shares?
Well, it's more similar than it is different. So essentially you would still buy and sell an ETF the same way you would a single share on the stock market. So you would just jump online or jump on the app probably and place the order the same way. So all ETFs will have a code the same way a normal company would. So you'll just jot that code in and then place your order to purchase the shares, and they'll also settle in the same way, which means from the day the trade executes, so not necessarily when you place it, but from when it executes, 2 trading days later, the trade will settle. So again, the same thing as when you're buying an ordinary share. And important to note as well that you will still be subject to the same rules and regulations when buying ETFs as you are with any other financial product.
And Ben, what is the role of a market maker in all of this? And firstly, what is a market maker?
Yeah, so a market maker is a financial institution that helps provide liquidity within ETFs. And so what that really means is that when you buy or sell ETFs, they're usually the organizations that you're trading with. And the market making process, it involves 3 parties usually. You have the ETF issuer or the ETF manager. So that's the organization responsible for the management of the underlying ETF. You have the market maker, and then you finally have the securities exchange. So in this case, that's the ASX. And the way that this process works is that if demand for an ETF increases above the available supply, what will happen is the market maker can go to the ETF provider and they can actually request new units to be made in the fund. And through that process, supply will increase to meet that new demand. And the opposite process is also the case. So when demand falls below the available supply, market makers can take ETF units off the market, they can take them to the ETF provider and redeem those units. And so the brilliance of this process is that market makers are actually incentivized to provide liquidity. And in doing so, they're actually able to, in some cases, make a profit. So as investors, we can always sort of trust that market makers will be there providing liquidity within ETF units.
And what is liquidity? Just going back to the basics there, and can market makers always provide liquidity?
Yeah, so liquidity it's basically the availability of ETF units that you see. So whether you're trading on a platform or an app, it's the amount of units that are available to buy or sell at any given time. And usually it's the case that market makers will be there to help provide that liquidity, again, because they are sort of incentivized to give that to the market.
So Laura, I heard that you have spent some time working as a trader in your background. So this question is for you. What time are markets open?
Well, without getting into the technicalities of it, all markets are open between around 10 a.m. to around 4:10 p.m. And just keep in mind, because as Ben touched on earlier, you'll be trading generally against a market maker and not another person in the market. So just keep in mind that liquidity can vary throughout the session.
And Ben, what price, if I'm going to buy an ETF, what price or how are ETFs priced actually?
So calling back to the market makers, these are also usually the organizations that price ETFs. And so the way they usually do that is using a calculation or a value of the ETF units called net asset value. The acronym for that is NAV, and that's basically, you can imagine it like the underlying value of the ETF. So for example, if there's an ETF that holds the ASX 200 and the ASX 200 goes up by say 10%, you can sort of expect that the NAV of that ETF to also rise by 10%. And so you can usually see the NAV on the fund web pages. So you go to the ETF provider's website and you can usually see that at the end of every day, they will publish a net asset value figure for their ETF units. And that can help you trade in line with the market value of the ETF.
Well, that brings to a close our 4-part series, education series. If you've enjoyed this, please share with others who may find it of value. Laura and Ben, thank you for your time.
Thanks for having us.